All right, can everybody hear me? Anybody there?
Yes, we can hear you.
Okay, thank you. I appreciate it. So I appreciate you guys jumping on here today. My name is Joe Bonaduce. For those of you that don't know me, I'm with Movement Mortgage. I've been a loan officer for 20 years. I've been in the top 1% of mortgage producers in the country for several years now, probably better than 10 years, I guess. And today I'm here to talk to you guys about our Movement Boost program and the USDA program as well. Before we get started, I'm just curious, how many of you have closed a USDA loan before? Anyone out there? Okay. A USDA loan is for a primary residence. It does not have a first-time home buyer requirement. Sorry, before I go further into it, I did send you guys some flyers on the two programs we're talking about today. They are in the chat. So if you want to open those up as we go along, so you can kind of check those out as well. But the USDA loan is for a primary residence purchase or refinance. Um, it is true 100% financing, no money down. The mortgage insurance is a little bit more than what half of what FHA charges. So you do get a reduction on the mortgage insurance with that program. I believe it's 0.3% per year versus FHA is 0.55% per year. It does have an upfront funding fee similar to what FHA does. The USDA's, I believe, is 1% upfront, and the FHA is at 1.75. So the USDA is an attractive, less costly option than what you're going to find with an FHA loan. USDA loans do need to be within a specified area. So it is geographically relevant where you are. Now, you guys, most areas around you are covered for the USDA. Um, if you want to check out which areas are covered and which are not, you can hop on Google, just Google USDA property eligibility, and it'll take you to their website. You put in an address of a property, and you can move the map around and see exactly which areas are covered and which are not. However, most of Eastern Pennsylvania, unless you're close to Philadelphia, is pretty much covered for the most part. And if anybody has any questions, please stop me at any time, guys. Everybody's got their names up here. I can't see any faces. So if you guys have any questions, just chime in either in the chat or just feel free to jump in at any time. So like I said, most of the areas around you are going to be covered for the USDA program. However, there are income limits with the USDA. Okay, there's a couple things with USDA that make it a little tougher to qualify, one of them being income limits. So I did pull up the income limits for your areas before, and I have them in the chat here. If you go into the USDA PA income limit flyer, it should have it there for you, at least some of the counties. So when I take a look at East Stroudsburg area, if you have a 1 through 4 person household, the gross income limit is 114,550 for the household. Yes, that includes anybody that's not going on the loan. If you have an adult child, an adult son or daughter living with you, and they have income, that does need to be disclosed with the USDA, and that will count against the income limits. Again, for the East Stroudsburg area, 1 through 4 person household, it's 114,550. Once you get to a fifth person, it goes up to 151,250. So for a 5 person household, you get a pretty high income limit. Even for the lower ones, those are substantially higher than they used to be. So those are the income limits in your areas for the USDA. Again, you do not need to be a first-time buyer for this. That's not a requirement. The other tough thing with the USDA is that it does have very strict requirements when it comes to your debt to income ratio. I'm assuming everyone knows what debt to income ratio is. If you don't, please stop me. I'm happy to go over it for you. The USDA debt to income ratio requirements are if you're a 680 or better credit score, your front ratio can be as high as a 33, your back ratio can be as high as a 43. If you are below a 680 credit score, your front ratio needs to be 29% or less. Your back ratio needs to be 41% or less. So USDA offers 100% financing, lesser upfront fee, and cheap mortgage insurance. However, the reason they're willing to offer these things to buyers is because they restrict the debt to income ratio much more so than any other program out there, really. And they feel that there's a very high probability that people are going to be paying and they're not going to have a lot of defaults because they are strict with the debt to income ratio. Um, One other thing with the USDA is keep in mind it does need to get actually sent out to a local USDA office for the final underwrite. That cannot be sent to them until the appraisal and everything has been received and you have a complete file. And then after our underwriters are done with it, it gets shipped to the USDA. Now, I've seen USDA approve loans in literally a couple hours. I've seen them take 2 to 3 weeks before if they're backed up. So it's just very important you keep that in mind when you're doing a USDA loan. I would strongly recommend a 45 to 60 day closing, not because of movement in our timeframes, but because you don't know what you're going to encounter with the USDA office and what type of weights you may have with those. In terms of interest rates on USDA, it's going to be comparable to FHA. Today, you're probably looking at about 6.5 or 6.375 on a 30-year fixed with the USDA. Anyone have any questions on anything? Okay, I guess we don't have any questions on the USDA program. Again, it's a great program. If you have any questions on it, please feel free to reach out. Unfortunately, the flyer I have for the USDA doesn't really give too many specifics on the guidelines. We'll be moving on talking about Boost now, if nobody has any other questions. The Boost flyer has a lot of details about the underwriting requirements and everything. The Movement Boost program is a proprietary product. Only Movement Mortgage has Movement Boost. And essentially what it is it's an FHA loan, and we're getting you a second mortgage to cover your 3.5% down payment, which is required by the FHA, and 1.5% of the purchase price to put towards your closing costs. So for example, on a $400,000 purchase, the Movement Boost is going to give you your 3.5% down payment, $14,000, plus an additional $6,000 to put towards your closing costs. Now, unlike some of your first-time buyer programs for the state of Pennsylvania or New Jersey for that matter, the Boost is a second mortgage. It is not a grant. There are payments on it. In our scenario of a $400,000 purchase, you'd be getting a second mortgage for $20,000. That $20,000 includes your $14,000 for down payment plus $6,000 to put towards closing costs. Your payment on that will run you about $200 per month. So there is a payment involved with the Movement Boost on the second mortgage where you wouldn't have that with the grant program. However, the downside to the grant program, if you take that in Pennsylvania, is that the state will not allow the grant, which is a lien against the property, to be subordinated. So if you want to refinance in a year when the rates come down, you won't be able to if you took the state program unless you pay back the grant money that was given, because they will not subordinate that second lien. With the Movement Boost, we will subordinate the second lien, so you would still have the option to refinance should these rates drop, which from what I've seen, for the most part, people are expecting the rates to come down hopefully within the next year, by the beginning of next year. So if you're somebody and you take the state program and your rate's 6.25 and rates drop to 5% next year, unless you have the money to pay back that grant, you will not be able to do the refinance. Whereas with the Boost program, you would be able to. Some of the highlights about the Boost program, and I'm pulling up the flyer myself now because I want to make sure I don't miss anything on here. But the Boost program is a true FHA loan. We don't have any additional guidelines. If it'll approve FHA, it will approve for Boost. You do have to have a minimum 620 credit score. I forgot to mention that. That is also the minimum credit score for USDA. However, it does go off the rest of regular FHA guidelines. We'll go up to a 56.99 debt to income ratio. And like I said earlier, that's one of the things with the USDA. It does limit debt to income ratio. Even if you have good credit, your maximum debt ratio can't be above 33 on the front and 43 on the back. Okay. With the boost program, being that it's FHA, will go up to a 57 back ratio. And typically you could get away with up to a 48 or 49 on the front as long as you're on under the 57 on the back end. So the boost program is very flexible. It gives a lot of money on the second mortgage to cover the entire down payment, as well as 1.5% to put towards your closing cost. This program has no income limits. You can still get gifts. You do not have to be a first-time home buyer for this program. They will not do 3 or 4 unit properties with the boost. It has to be a single or 2 unit family. FHA approved condos are fine. Manufactured homes are fine as well, as long as they meet the other guidelines. Manufactured homes do require a 640 minimum score for the movement boost program. Any other questions, guys? Any questions on anything?
What are you seeing as average loan amounts recently?
I mean, that really varies by what area I'm in. When I'm out in Pennsylvania in your area working out of your office, a lot of the leads I get, people are looking to buy stuff, mid twos up to mid threes seems to be pretty popular. But I also work in areas in New Jersey where, our average purchase price is probably closer to 800,000, quite frankly. So, it varies based on which area that I'm working. Any questions on the programs we went over, either USDA or the Boost program, or quite frankly, questions on anything mortgage related, real estate related? I'm happy to help in anything that you guys might have questions on.
How soon after the first mortgage can a person buy a second primary home?
I'm sorry, say that again. You broke up a little.
Oh, how soon after the first mortgage can a person buy a second primary or buy another primary home or moved from the first primary to the second primary?
Okay, so somebody bought a primary residence recently, and now they want to buy a new primary residence.
Yes.
Okay. Number one, buying 2 properties like that and buying both of them as primary is going to be a red flag to an underwriter. Underwriter's going to have questions about that. Okay, you just closed on this home 3 months ago as a primary residence. Now you want to buy a new primary residence. Explain that to us. Why is that? Why do you want to move to the new property? They're going to have a decent explanation for that. Okay. And the number one thing that people commit fraud with in the mortgage world is occupancy, and banks do check. Okay. There was a story a couple years ago in New Jersey. A New Jersey state trooper bought a 2-family house in Newark, said he was going to move in, did an FHA loan, never moved in. He got sentenced to 3 years in prison for mortgage fraud. So there's going to be questions with the underwriter. If they're legitimately going to be moving from one property to the next and they have a decent explanation as to why, you should be able to get it through and it should not be a problem. Okay. But there is no actual set amount of time. It's not like, well, if they're there a year, there's not going to be any questions. It's really the underwriter's discretion, and they have to build their case. I mean, maybe they bought the house and, now this house that they absolutely love just became available and they have an opportunity to rent out their current house. Explain it all. I mean, life happens. I had a guy close on a house. His mother unfortunately had a stroke later. He had to move to Florida and rent his current house out because he couldn't afford to pay for it if he didn't rent it out. He called me in a panic, is he going to get in trouble for renting it out? And I explained to him, you had a change in life circumstances. Nobody's going to question that. I mean, your mother unfortunately had a stroke. You had to move to Florida to take care of her. So a change in life circumstances, and now it's a rental property. He was just fortunate that the rent was going to be enough to cover the mortgage enough that he was going to be able to keep it. But to answer your question, there is really no definitive minimum amount of time somebody has to be in a home. But if they try this again and again, it becomes more and more suspicious every time. So,
Yeah.
they better have good answers for the underwriters, and your loan officer better be able to present it in the proper manner.
Okay, thank you.
You're welcome. Happy to take questions on anything mortgage related, guys. Anything real estate. More than happy to help you guys out.
Can you go over the PHFA? And what's the inspections that are required with that?
Okay, I will be honest with you. I don't know exactly which inspections are required for the PHFA. I would imagine it's going to be a water test if it's well water. I don't believe they require septic test. I would have to actually get the list for you from the PHFA. In terms of the PHFA, it's essentially the movement boost, but it's a grant. You get up to 5% of the purchase price. The catch with it is though, even though it's a grant, from what I understand, once that 5 years or whatever is, or 10 years is gone, you do actually get a bill though you get a tax bill. They will consider that to be income. The grant through the state, I'm told, is actually considered income. And after that time has passed, you will actually be given a tax bill for that grant as income. You get a 1099 for that as income. Again, that's one of the reasons that I kind of feel the Movement Boost is a more favorable program than the state programs out there, be it New Jersey or Pennsylvania. However, some people really don't want a second payment. You know, they don't want to deal with the boost because it has a second mortgage payment. However, the state program only has the one payment, but you do get hit with the tax bill at the end. And as I stated earlier, you can't refinance out of that program because the state will not subordinate that grant as a second lien. They won't subordinate it to do a refinance. So you would either have to pay that off or wait to refinance until that time frame is up. I can find out though about inspections that are required by the PHFA. I will find that out for you. Just made a note to look that up for you after the meeting. Anybody else questions on anything? All right, guys. If no one has any questions, I mean, I don't want to keep you guys hanging around here all day. I pretty much went through the material on those two programs. If there's anything in particular you want to discuss, feel free to let me know now. Otherwise, we can all check out and get back to work. All right, guys. Well, thank you for attending today. I do appreciate it, and I hope you got something valuable out of this situation. Evelyn, I believe you were the one that asked about the PHFA, so I am going to look into that for you, and I will get back to you shortly.
Thank-
I got to make a quick phone call, and I'll have that list for you right away, okay?
All right, thank you.
You're welcome. Anybody else questions? Otherwise, I'm going to say let's end the meeting, and we'll check out here. All right. Well, thank you all very much. Everybody have a great day. Hope to see you again soon.
Yeah, thanks.